Welcome, astute investors and business professionals, to a crucial discussion that delves beyond the superficial numbers on a company's financial statements. Today, we're dissecting two fundamental metrics, revenue and earnings. While both are indicators of a company's financial health, they tell very distinct stories. Revenue, often referred to as the top line, represents the total sales generated, a straightforward measure of a company's market presence. Earnings, or net income, on the other hand, signify the bottom line profit, what's left after all expenses are accounted for. Our primary objective is to equip you with the insights needed to assess the quality of business growth, a critical concept that distinguishes truly robust, sustainable expansion from mere fleeting market share gains. Understanding this distinction is paramount for making informed investment decisions and identifying companies with genuine long-term value creation potential. Let's begin by unpacking revenue, often the first number investors look at when assessing a company's performance. Revenue, sometimes called sales or the top line, is simply the total amount of money a company generates from its core business activities, such as selling goods or services, before any expenses are deducted. For example, a retail company's revenue would be the total cash received from customers for all products sold. High revenue growth can indicate a company's ability to expand its market share, capture new customers, or successfully launch new products, showcasing strong demand for its offerings. It's a vital sign of market acceptance and operational scale. However, it's crucial to remember that revenue alone doesn't tell the full story. A company could be generating significant sales but still operating at a loss due to high costs, aggressive pricing strategies, or substantial reinvestment. It's the starting point, not the destination in our financial analysis. Now, let's turn our attention to earnings, or net income, which represents the real profit a company makes after accounting for all its costs. To calculate earnings, you start with revenue and then subtract the cost of goods sold, operating expenses like salaries and rent, interest payments on debt, and finally, taxes. This bottom line figure is what's truly available to shareholders, either for reinvestment in the business or distribution as dividends. Earnings are a direct measure of a company's efficiency, cost management, and ultimately, its ability to generate wealth for its owners. A company with high revenue but low or negative earnings might be struggling with operational inefficiencies, pricing pressures, or unsustainable growth strategies. For investors, consistently growing earnings are a strong indicator of a healthy, well-managed business that is creating sustainable shareholder value far beyond just selling more products. While revenue shows how much a company sells, and earnings reveal how much profit it keeps, it's the interplay between these two metrics that truly matters for investors. A company might boast impressive revenue growth, say from 100 million to 200 million in a year, which sounds fantastic on its own. However, if its expenses have grown even faster, leading to stagnant or declining earnings, then that growth isn't necessarily a positive sign. Conversely, a company with modest revenue growth but significant earnings improvement through better cost control or pricing power is likely creating more value. Think of it like a personal budget. Earning more money is great, but if your spending increases disproportionately, you're not actually getting richer. Both metrics are essential because revenue signals market acceptance and potential, while earnings confirm actual profitability and efficiency. Ignoring one in favor of the other provides an incomplete and potentially misleading picture of a company's true financial vitality and its quality of growth. The concept of quality of growth is where sophisticated investors truly differentiate between fleeting success and enduring value. It's not just about how fast a company is expanding, but how it's expanding. High-quality growth is characterized by consistent revenue expansion coupled with improving profit margins, strong free cash flow generation, and efficient capital reinvestment. This indicates that the company is not just selling more, but doing so profitably and sustainably, often due to a strong competitive advantage, superior products, or excellent operational management. Conversely, low-quality growth might involve aggressive pricing to snatch market share, heavy reliance on debt to finance expansion, or growth that doesn't translate into positive cash flow, potentially leading to financial instability down the road. For instance, a company showing 30% revenue growth but eroding gross profit margins from 50% to 35% is exhibiting lower quality growth than one growing revenue at 15% with stable or improving 55% gross margins. Investors seek growth that is not only robust, but also financially sound and sustainable. To truly evaluate the quality of a company's growth, investors delve into several key metrics beyond just top-line revenue and bottom-line net income. Gross profit and gross margin are essential, revealing how much profit a company makes from its sales after deducting the direct costs of production. If a company's gross margin is shrinking, it suggests pricing pressure or rising production costs, even if revenue is growing. Operating income and operating margin go a step further, indicating profitability from core operations after all operating expenses, but before interest and taxes. This shows how efficiently a company is managing its day-to-day business. Free cash flow, or FCF, is arguably one of the most important metrics, representing the cash a company generates after covering its operating expenses and capital expenditures. A company with high revenue and earnings but negative free cash flow might be relying on accounting adjustments or unsustainable practices. Analyzing GAAP and non-GAAP earnings also provides a more comprehensive view, with non-GAAP often adjusting for one-time events to show recurring profitability.
Let's consider a hypothetical scenario to clearly illustrate the difference between high and low quality growth. Imagine Company A, a tech startup that reported revenue growth from 100 million to 200 million in a single year, a 100% increase. Sounds impressive, right? However, upon closer inspection, its net income barely budged, remaining at $5 million, and its free cash flow was negative due to aggressive spending on marketing and deeply discounted sales to gain market share. This is an example of lower quality growth, rapid expansion, but not sustainably profitable. Now consider Company B, a different tech firm. It grew revenue from 100 million to 130 million, a more modest 30% increase. Yet, its net income grew from 10 million to 25 million, and its free cash flow saw a significant positive jump. This is indicative of high-quality growth, profitable, efficient, and generating real cash. Company B is likely leveraging pricing power, operational efficiencies, or a strong brand, leading to better returns for investors over the long term, despite slower top-line growth.
For investors, understanding the quality of growth is paramount to making informed decisions and avoiding potential pitfalls. Focusing solely on revenue growth can lead you into growth traps, where companies appear to be thriving but are actually burning cash or struggling with profitability. Instead, a discerning investor looks for companies that demonstrate consistent revenue expansion alongside healthy and improving earnings and robust free cash flow. This combination often signals a strong business model, pricing power, efficient operations, and a sustainable competitive advantage. It helps identify companies that are not just generating sales, but are also converting those sales into real value for shareholders. By analyzing these critical metrics, you can identify businesses with long-term viability and potential for superior returns, rather than those relying on short-term, unsustainable tactics. Your investment decisions should be grounded in a holistic understanding of a company's financial health. In conclusion, while revenue provides a snapshot of a company's sales activity and market reach, and earnings reveal its profitability, neither metric should be evaluated in isolation. For the astute investor, understanding the quality of business growth demands a deeper dive, an analysis that considers how sustainably and profitably a company is expanding. This holistic view combines the top-line insights of revenue with the bottom-line efficiency reflected in earnings, further enriched by metrics like gross margin, operating income, and especially free cash flow. Moreover, it's vital to consider qualitative factors such as management quality, industry trends, competitive landscape, and a company's long-term strategy. By integrating these financial and qualitative insights, you can move beyond superficial numbers to identify businesses with truly robust, enduring value creation potential. This comprehensive approach is your strongest tool for making informed investment decisions and building a resilient, high-performing portfolio for your financial future.